This is the method I use myself for HEX staking. It's called Mount Fuji, and I will explain the reason why in the future. But for now, what you have to understand is that it's a modified version of the conventional staking ladder, which aims to solve some problems that I had. So this method of staking has the following objectives, which is to remain liquid, earn the yield, bet on price appreciation, and increase the basket staked across time, right? Actually, not the basket, but increase the amount of time staked. And I'll explain how I do that. But the first thing we have to understand is how the conventional normal staking ladder works. The conventional normal staking ladder works the following way. You have $100 here, and you're going to get the $100 by HEX and stake to the future, X date, whatever date you choose. And you believe that in the end of the period, you're going to get your $100 equivalent in HEX, right? Of course, the price oscillates across time. So anyway, you're believing that you're going to get at least the equivalent of $100 staked plus X, which is the inflation in the future. So for every given period here, you're going to make a basket staked for the next period in the future that you choose, like 1 year forward, 2 years forward, whatever. 1 day forward, 1 week, whatever you want, you know? This is the fun of HEX. There's a lot of ways to skin the cat. Anyway, so this is how the conventional staking ladder works. Now, this method has some weakness, which is the following, right? The first problem that we have is that you are illiquid for this given period that you staked. Let me explain in practice. Let's say that across 4 weeks here, what you got is 1, 2, 3, 4. You get $400 staked to be released in a given period in the future, right? Let's say you put a stake in there of 1 year, which yields at least 10% a year, right? As APY. Well, the problem is that you have these $400 locked, and I don't think this is optimal because of the second problem. You are ignoring the price. What do I mean with that? I mean that the market oscillates across time. So eventually, the market may hit a very big target, which you may be satisfied with, and you would like to sell all your stakes there if you could, with enough liquidity, but you cannot because you're locked. I know that there are derivatives that allow you to do that, but the main liquidity here is in HEX, not the derivatives for now. So it ignores the price. Imagine the price hit a target and you want to exit all your stakes here. You just can't because you are locked for too long. So you're not liquid and you ignore the price. You forgot that in the future you would like to sell at the top of the top, you know, if you could, if you know how to detect the top, first of all. And the third problem is that it requires a constant cash flow. Well, because you are supposedly buying $100 every week, every month, and staking in the future. So theoretically, in order to keep your staking ladder standardized, you would have to stake $100 for each given period, for each period here. This is not optimal to me. Why? Because I have the following desires. I want to remain liquid. I want to take price into account to make decisions based on price. And the third is sometimes I'm not going to be able to buy every week. Sometimes I'm going to be able to buy every 3 weeks or every month, you know? So this is not optimal for me. So what I built here is what I call just an example here. This is why it's called the staking ladder, right? Because it's a standardized staking method across time. So I decided in the same time pattern between each stakes. Anyway, so what I decided to build is something that I call the Mount Fuji method of staking, because it simulates um, the format of a mountain. What do I mean with that? In the base of the mountain, you have the principal, right? In the base of your stakes, you have the principal. And the principal is the largest part of your game, so to speak. And what you're going to do is you get the principal and you stake for 1 week. We're going to work with weeks only, 7 days stakes, because 7 days is enough time for you to make a decision, right? Take a sip of my wine here. So you're going to work with weeks. And what you're going to do is you get the principal and you stake for 7 days, right? And after staking for 7 days, you're going to get the inflation after the 7 days. So you're going to get the inflation that you just yielded here during the 7 days, and you're going to stake you're going to stake in a future date based with a monthly step. What do I mean with that? So you start at week 1. At week 2, you're going to withdraw the amount that you earned as inflation, just the inflation, not the principal, and you're going to stake it for, let's say, 3 years forward, starting in January, right? And you're going to repeatedly do this. So at week 2, you're going to stake for 7 weeks, and you're going to get the yield at week 3, and you're going to stake to February for February, like 3 years forward, for example. And during the week 3, you're going to stake for 1 week, and you're going to get the inflation and stake for the next month forward uh, in the period that you choose, right? For example, if you choose to start your staking ladder just after 3 years. So you start in January and then you start to fill February, March, and so on with the yield of every week. So this method here is aiming to keep you liquid. So every week you're going to have your entire principal unlocked so you can make a decision if you wish. You're going to bet on price appreciation. What do I mean with that? I mean that when you're getting the inflation here, probably the amount of HEX in this inflation that you receive is very small compared to the principal, right? Right. But the problem is that we are talking about an asset, not the problem, actually the benefit is that we are talking about an asset that supposedly is a good asset. And good assets across time, they tend to increase in price. So this inflation that you are receiving for 7 day stakes today is going to be way more way more valuable in the future in dollar terms. So for example, let's say you receive $100 as 100 HEX as inflation here. For now, considering that the HEX price is like 0.02, this is nothing, right? But imagine in the future, like 3 years forward, the minimum price of HEX was $1. We're talking about some few 100% in valuation over the inflation here, right? Plus the yield that you're going to receive. So this is what I mean with betting on the price appreciation. You are not being diluted, right? You are earning yield and you are avoiding dilution because every day there are stakes being released. And what you're doing here is making the game, like playing the game the proper way so you don't get diluted. Plus, you're betting on the future appreciation of the asset. Plus, you are helping the HEX network, let's say the HEX staker network, to delay the inflation even more. So this is a method to help the HEX community to delay even more the inflation, play this game properly, right? Why is it called Mount Fuji? Well, because the big base, which is your principal, is way larger than the small top, which is the yield in HEX that you get every week. But on the other hand, you remain liquid. So let's just summarize it and let me give you some data about this method. This means that using this method, in 4 weeks, you are going to stake the equivalent of 4 months in the future, which means that in 52 weeks, you complete 4 years, which is equivalent to 52 months. Actually, it's 48 months, but I just did a rounding here for 4 years, right? And well, considering Bitcoin cycle and HEX cycle, 4 years is one cycle. So in 1 year, you stake it for one cycle forward, right? And using this method in 3 years, which is usually what it takes in a cycle, you completed a 5555 stakes in HEX. So after 3 years doing this method every single week, you are going to have reached the wonderful 55555 stakes, which yields about 38% a year or 34% a year. And this means that you are basically doubling your initial principal after 2 years, and then doubling again after 2 years, and like insane. And it just takes 3 years, man. Imagine if you did it during the bear market that HEX had, right? And this means in the same way that after 3 years, when you just finished your 55555 stakes, you would start to collect yield from the first batches. Why did I wrote this thing here? Because my recommendation is that you create the first batch after 3 years. The first batch after 3 years, today, the end of 2024, is equivalent to 10% a year APY, right? So this is the benchmark that I took, because I know that there are stocks which allows us to have a 10% yield per year. So I wanted to beat that, or at least be equivalent to that. So it takes at least the minimum 3 years of stake in order to reach it. And the most important thing is we do expect price appreciation over a long period of time. But what you need to have in your mind that you're probably not going to fulfill this 3 years staking, right? Unless you just got the bear market just in the face, Because, well, there are bull cycles, and if you have some idea how to properly trade bull cycles, there are tops, right? You should exit on tops. I mean, you're not that you should, because no financial advice from my end, but it's wise to do so. Anyway, this is how I use the Mount Fuji staking ladder. Because for me, with my profile, I want to remain liquid, I want to earn yield and not be diluted, and I want to bet on price appreciation over time. So I believe that the inflation that I'm receiving today will be way more valuable in the future. This is my strategy, and I recommend people to take a serious look on it, because it's a really good one, instead of just holding the liquid bags and be diluted across time. Another thing that I'm going to talk in this video is how to plot your targets here. So, well, I'm talking about defining your targets during the bull market, but you probably don't have any idea how to do that. And to be honest, nobody knows where the tops are, right? Nobody knows where the tops are. I mean, you could take a statistical look in other currencies and kind of find your targets, or you could use the inversed Fibonacci here over the retracement, and you're going to have the 127 and the 161, which are always great targets, right? But in fact, you don't know what is going to happen. And choosing a fixed price for all your principal is not wise too, because when the bull market hits, nobody knows where the top is, right? So here's the thing. I created a strategy, an exit strategy for myself, which is based on my own psychological behavior with the equity curve, with the equity of my account, right? So for example, imagine that, let's talk about HEX here, right? And I'm going to take this chart, which is just the post-chain chart, and after presenting this one for you guys, I'm going to go into the HEX chart itself, which considers the HEX price too, right? Because we know that the economic energy is not only PHEX, but it comes from EHEX, right? Because the network was forked. Anyway, I'm not going to explain this right now, but what you need to understand is that this is the method that I use. So I take the historical top here, and I imagine a future top that I would be satisfied to exit a part of the principal when it gets there, in a way that in case this was the top and it retraces back to the previous structure, what do I mean with that? I mean that the market usually makes the following structure, right? You have a top and you have a bottom, and then you have a new top here, and the next retracement comes to visit the previous top. This is what the market always does, right? Except for some rare cases, right? So what I'm talking here is that I believe that the price is going to revisit the historical all-time high of the previous cycle. This means that uh, I I believe that the price at some point is going to revisit this historical top. So what I should do is to imagine what could be a top that in case we retrace 50%, it would hit the previous cycle top. And this becomes my first target. Why? I'm telling you this way, I'm using this method because it's pure psychological. If the market hits this price point and it retraces 50%, because I know that it should retrace to the previous top, to the previous cycle top, I would be sad, man. I would be sad to leave 50% of my profits there. So I have to take some profits here. That's the fact. Minus 50% as retracement is equivalent to 100% from the cycle top to the price I'm talking about. Do you get what I'm saying? Anyway, you should pause the video if you don't understand, because, well, it's not so easy. So this is the 50%. Why do I take the 50%? Well, the psychological aspect, and I did some studies myself to know that um, the coins that did kind of a false breakout, they just hit plus 100% from the previous top, and then it breaks down. And then I start to make a little ladder here, which is selecting minus 70%, minus 75%, and I do the same way till we hit 90%, which is the highest price I found in crypto for altcoins that the market could reach before making a bear market. Actually, the highest was 95%, but it's so rare that I just excluded. Beyond 90% is really rare, right? So these are my targets considering only pulse price appreciation from the chart based on the chart that we have here. If you take all these targets that I'm showing you here which the highest one is 0.41 cents. If you take all these targets here and you get the average price, what you're going to have as the average price is this um, average price here. Let me show you a few seconds. You're going to have the average price of, we're talking about PHEX, you're going to have the average price of 0.22, right? 0.22 as the average price is the equivalent of 1,400% from where we are now. Okay? This is how I see it, just for PulseX. Well, the thing is that I'm not considering only PulseX because I know that in the past, the economic energy came from Ethereum. So if you use the same method, considering we are going to go for CHEX, right? So ignore EHEX here. Think this way. Considering CHEX, the bottom of HEX price was not less than 0.001, right? It was actually, where was it? It was 0. I think it was 0.01 or something. I don't remember really well what was the CHEX price. So anyway, I'm going to show the other screen here so you guys can have a better idea. So what I'm talking about is that the CHEX price come to, it was around this price here of 0.001, right? Is where the CHEX price went as a minimum value, or 0.002. I don't recall really well. Anyway, the historical top of HEX, of EHEX, is the historical top of CHEX. This means that in order to calculate the targets that I just shared with you guys, you need to consider the following top 0.555555. Yeah, I say 5555, 0.50, right? 0.50. I say 0.5555 because this is what I believe that the target really was, right? But whoever was the whale here got front run by people. You know, of course the target was 55555. I mean, of course. Anyway, so these are your targets for CHEX. And the targets for CHEX, if you take the average price here, you're going to end up with this amount, this average price here, 2.0, right? Which I believe that talking about CHEX, we are trading at 0.20, right? 0.20 if I'm not mistaken, which is the equivalent of 10,000%. This is crazy, guys. 10,000% is a lot. So my tip is if you hit the 50%, like you should create a risk management, a well risk managed trading strategy, which I'm not going to cover right now. I just wanted to share the staking ladder and the HEX targets for you guys. So here it is. You can consider these targets here and you can consider these targets here. What I did is I separated my principal in, by the way, I'm adding to my principal every month. But what I did is separate my principal between the PHEX target and the CHEX target. So I split it in half. So half of it I'm going to exit at these targets and half of it I'm going to exit at these targets right here. Pretty straightforward, right? This is a very extensive video. I could not make it shorter because there's a lot of content in it. But anyway, that's it.